Hey everyone, welcome to CoveredCall ETF Investing, your central hub for deep CoveredCall ETF data. In today's video, we are flipping the hood open once again on the whole portfolio, doing a full 360-degree overview of a 100% equity-based CoveredCall ETF strategy from the perspective of a Canadian. Okay, so let's get into that right away, not waste any time. We will be discussing asset allocations, the different varieties of diversification that I invest in, my own strategy, what am I working towards, short-term goals, long-term goals. We will look at performances of the whole portfolio versus indexes, the total return of every individual ETF. We'll also look at just income as well, what it has contributed to this year, how does that grow, and tangible use cases. Why would a young guy like me, because I know so many of you guys have especially in one-on-ones have called me that, young guy like me at 34 investing in CoveredCall ETFs, products that are typically geared towards a much older crowd, those who are near retirement or at retirement. Why would I possibly want to invest in these things and even have a channel covering all this stuff? So we're going to get into tangible use cases towards the end of this video. So let's move right along. We'll keep things hopefully pretty tight here as far as what's being covered. We'll start with the spousal RSP. So this portfolio exists for the sole function of investing in it for my wife. I am what's known as the contributor, so I get the tax break. My wife doesn't earn an income, so she would be what's known as the annuitant for this. The basic idea here, and we set this up so that I would still get the tax break, but if we stop contributing to it for about a 3-year period, then we could, at the end of those 3 years, take it out at a much lower tax rate in the annuitant's name. So that would be obviously my wife's name at that time. And so far, we are 1 year into not contributing, 1 year as of last August. So 2 more years, and then this portfolio is going to be relinquished. HYLD.U, why this fund, why not any other fund? It was meant to just be a placeholder in this portfolio. I had XYLD, wasn't really happy with it. It's just natural price performance overall, go figure, for those who are familiar with XYLD. So I decided to sell that off, get into HYLD.U while I researched and tried to get into something else. But you know what, as time went on, I was actually quite happy with the distribution predictability of HYLD.U, its natural price performance growth. It's an ETF that invests in other ETFs, so it's an all-in-one across many different sectors in the US. And you know what, it's just a fund I'm overall happy with. I'm just going to keep it as is, as boring as it is, just one fund. With that being said, let's move over to the more exciting portfolio, which is my TFSA. This portfolio has undergone a lot of change actually since the last overview. I had a bunch of sector-specific funds in here, like ENCL for Canadian oil and gas. I had UMAX for Canadian utilities. I had BKCL and HMAX for Canadian financials. I got rid of all of those mainly because this portfolio was always meant to be more of an all-in-one based portfolio. So it just took time to get there. I thought I might hold on to those sector specific funds in this portfolio heading into 2025, but the timing was just right. I felt like I just wanted to just eliminate those for now. I will get back into those sector funds once I start investing in a non-registered account, but that's probably going to be April, May of next year, roughly. Really, the main core idea with this portfolio is, yes, again, all-in-ones, it's simple, and I wanted, and mainly 2 other reasons. I want predictability in my distribution output, and I wanted funds, or at least as a whole, the portfolio could grow naturally over time, that this portfolio wouldn't be reliant on necessarily reinvesting those dividends. I do that currently, and for the foreseeable future, no matter what I'm about to share in this video, I want this portfolio to stay reinvesting, but I don't want it to rely on that. So the main idea here is invest in funds that can eventually, I shouldn't say eventually because it's currently doing that, but just grow naturally, price performance alone, and not rely on those dividends. So those are, I think, two key aspects of this portfolio. Different layers of diversification in here as far as geography is concerned. It's about 70% American, 20% Canadian. It's about 8% developed markets, 2% emerging markets. As far as fund manager diversification is concerned, we got about 40% Hamilton, 30% Harvest, 20% Global X, and 10% BMAX. The main idea with fund manager diversification is, unless your name is Vanguard or BlackRock, I think it's probably not a bad idea just to get your feet wet with different fund managers that add a little flavor of different strategies. For instance, HDIV and BMAX, these are not funds that are trying to mirror a specific index. They're kind of just their own thing, whereas, say, HYLD is trying to mirror the S&P 500 a little bit more. So you get a slight variety in strategies there. So I like that. So the more diversification, I know there's going to be tons of overlap. I understand that. I'm okay with that. That's fine by me. But I'm definitely much more interested in those sort of other layers of diversification in there. So as you can see here also on the side, the way this works is you set targets with Passiv, and it basically tells you how accurate you are to that target. So we can see that I would say at the moment HTAE is the only one that's the farthest away from its current target. So what this will do is it'll tell you as you contribute more money to your brokerage, Passiv picks up on that, and it'll tell you basically how much you need to buy, or at least how much is available to get you at least closer to, say, in this case, that 20% target. So that's really helpful to have. With having an all-in-one based strategy approach, it's much more conducive just to dollar cost average, split it amongst all the funds. And when opportunities arise, it makes more sense with maybe sector-specific funds or single stock CoveredCall ETFs, that you would maybe have more of an approach of, invest in this when the market is much weaker. So it kind of leans more towards the timing of the market versus just dollar cost average whenever you get a paycheck, and take a percentage off of that and stick it in here. So I like to keep things simple, and basically once a month I contribute to all of these, break it down, and invest across the board in all of these. So, but some of these do tend to drift based on growth, natural growth. Others might lag behind based on maybe the fund value is going down, but ideally it stays within an accuracy that's really high. So right now accuracy is at 99%. Totally happy with that. Even if it was at 95%, I'd be happy with that. But the idea is at least stay close to these targets as best I can. You've pretty much kind of gotten an overview of what I want for the portfolio. Let's actually start to look at performance. So we are now in Wealthika, which is a full-on aggregator investment tool. You can link all your different brokerages to this, and it gives you a nice, easy, sleek layout of what your portfolio is doing over the course of time, how you contribute to it. I know for a lot of people, this is like their favorite part with the overviews. So we'll start here. So in January of 2023, this was my portfolio, $209,620. And then over the course of that year, as we were going along, through just fund growth, or I should say portfolio growth naturally, reinvesting those distributions, contributing, or I should say, contributing to the portfolios. This is what wealth building is really all about. It's not necessarily just about one thing in particular, but it really has more to do with the mentality, looking at all three of those contributing factors. So we keep going here into 2024, and we are now at basically 200 and I would say 1,000. I know there's a dip here. That's an error. I don't know there might have been a sinking issue. It's definitely happened before, but I'm at around $201,000. And you can even see it here, $202,648. So as far as fund performance is concerned, when you factor in price performance, reinvesting, and then contributing, again, all encompassing, and it's helping this fund, these portfolios grow in the way that they are. So now that we had a look at that, let's go to holdings and look at the individual performance of every single one of these ETFs that I hold. It's kind of nice that it's sort of all down to just a few now. I think it's 6, 7 in total. 6, 4, 5, 6, 7. Yeah. Okay. So on the sidebar here, we see that this is the price performance of everything all time. So with HTAE at the moment, 9%. At one time, this was up like 22%. But being that it's a pure tech CoveredCall ETF, its volatility is really crazy. So in the good times, rocket fuel. In the struggling times, an anchor. That's what I like to say with HTAE. But still a really great fund to have, I find. Followed up by HYLD.U. So in the year that I've held it, 8.38% over the course of 1 year. Pretty good for a CoveredCall ETF, which is, not expected. There's very little expectation that these funds are supposed to naturally grow. You get a lot of, I certainly have seen many comments about that these funds will never grow, they'll depreciate into oblivion, but that is simply just not the case. You do the right research, put enough education behind it, and you'll find that all of these CoveredCall ETFs are all very much built differently. I have found that we can get a diversified batch of CoveredCall ETFs, all-in-ones like this, that focus kind of in that 10 to 12% range, and they'll have the ability to have much more natural price appreciation attached to it. I think beyond that sort of 12% range, you start getting into a bit dicier territory. You're going to have to rely on more sector-specific funds, but don't necessarily have the ability to naturally grow over time. I think you're much better off with a fund that is diversified across all sectors in that regard. So the only lone bit of red we see in here is EQCL. This is much more of it is a more recent buy, so I probably bought this in July. So market was pretty high back then. The simple reason why I even bothered getting out of USCL, the main reason why I decided to invest in EQCL and swapping that out with USCL is really I like the idea of a globally diversified fund, and the fact that EQCL has on average 11.5 to 12% yield. It's got 25% leverage, which will be an ally in the long run versus an enemy. And the fact that it also invests in the big major indexes, S&P 500, NASDAQ 100, TSX 60, the big developed markets index and emerging markets index. I think it certainly, for me, it had a place. And the only reason it wasn't there before, EQL did not have about 40% or roughly of the portfolio that was not CoveredCall based. So it is now, and it's in the portfolio. It will be there for the long term. Okay, so let's look at just total return over the course of time since I've held all of these funds. You can see HYLD is up 30%. I gotta treat this version of HYLD with a bit of an asterisk. It was once everything in my TFSA at one point, and so I had to sell off. I didn't have to, but I decided to sell off a bunch. So unfortunately, this number is a little bit skewed. Which is really too bad, but it's just when you buy something, you sell it off, it really messes with, it'll pit the current income versus the new essentially book value of that fund. So it's much higher than it actually is. But everything else I never sold off. I've just only added more and more and more to it. So we get, say, a total return with HYLD.U of 20%, which is, I've put one amount in and I've only been reinvesting it on drip this entire time. And then HTAE is no different. Total return, I've had this for less than a year, up 15.5%. BMAX, again, no different, up 15.38%. What's amazing with BMAX is that even though we're in a period of maybe correction territory, the market's a little weak right now, which undoubtedly affects funds like HTAE, which are basically funds on steroids with investing in full tech. BMAX as a diversified fund is, on its total return basis, I bought these funds around the same time, is really keeping up with HTAE. Now, sometimes HTA does rocket ahead. I've had earlier this year, it had a price performance of like 22% at one time. So, it bounces around quite a bit. It's been up to 22% and currently down to 9%. But, hey, overall, BMAX just being a steady stalwart within the portfolio. HDIV not far behind, basically 14% total return. Had that for a little over a year, I think, at this point. Same with HDIV, 8.98%. It's mostly invested in the Canadian market, so because it misses out on a lot of the tech growth, and Canada really not known for tech, it will lag behind some of these other funds that invest more in the US. I think only 25% of this fund is invested in the US. And then, of course, we got EQCL. This is more of a recent pickup, so probably bought this more or less when the market was pretty high in July, when I swapped out USCL for this. And either way, even though it's down, it's there to stay for the long run. So I suspect within time, of course, this will be green on a total return basis. Anyway, so get a little bit of nice price appreciation from everything, despite here in early September of 2024, despite there being obvious economic disturbances that have really shrunk the size, the value of this portfolio. It's still, on a price level, it's still holding up extremely well. So next thing we'll get into is the power-ups. We'll go over to performance. And we'll actually just look at a chart of what my entire portfolio looks like on a total return basis. All right, everybody. So here we are looking at the performance of my portfolio versus other indexes that are out there. We're talking S&P 500, Dow Jones Industrial, NASDAQ 100, and the TSX 60, right? So that's the Canadian, essentially, S&P 500. Okay, so as we kind of move along the year, really the NASDAQ, my portfolio, and the S&P 500 kind of follow much more of a closer range with one another, as a lot of my portfolio is trying to mirror a lot of the NASDAQ and the S&P 500. So it's a bit of a mix of in between. But to date, to my sole surprise, this whole year, the 100% CoveredCall ETF based strategy has actually been beating out these other indexes. Now, things have really tightened up. Maybe back in August, there was a much bigger gap between my portfolio and the NASDAQ and versus the S&P 500. There's been times where the NASDAQ has been ahead this year at periods, but more recently, since August, this portfolio has been pulling ahead. Even back in April, this portfolio was staying just a little bit ahead of the S&P 500, staying just a little bit ahead of the NASDAQ, kind of trading positions every once in a while. But to date, basically what I've invested in has been able to beat the market. I would love to say at the end of the year that my portfolio beat the market. That would just be a fantastic thing to say. I don't think it's not going to do that in the long run, but it would be something just fun to say. Looking back, on 2024, that was the year that my portfolio beat the market. So now I feel like I'm in this run and gun battle at the moment. When it was earlier in the year, I cared less. Overall, I don't really care, but it would be kind of a fun little exercise just to keep note on. So you all can look forward to that in my weekly performance post every Saturday that I put out, and this chart is a part of it. So check it out over there week after week if you want to see if my portfolio is staying ahead of all the other indexes that are out there. Okay, so now that we've looked at that, we see what the performance of this whole portfolio is. Again, it's total return based. Let's head over to income. Okay, everyone, so we are now looking at the month-over-month change in the distributions that I have received. Month-over-month, you can see that it's pretty stable. For the last 12 months, I've been fully invested in ETFs that pay out predictable distributions. There was a time where my distributions were all over the place, be way up, way down. I get a lot of questions about that, but it just had to do with the variability of XYLD when I held that in the spousal RSP. But now it's been a full year. We can actually see month over month how things have grown. So we started in September of 2023 at $1,434, moving up roughly, I want to say by this point, it's probably up about maybe 25% roughly, or even more than that. You can see in August is obviously the most I've ever had at $2,067.79. Okay, so from $2,067 up from $1,437, all within 1 year. Again, contributing, staying consistent with contributions. If that's something you struggle with, I actually find I did way better with contributing, or have been much more consistent with contributing when I had a fixed number. So for me, that's $1,000. Every month, I'm always trying to push for that $1,000 mark. It's a hard number to hit, for sure. It's a tough number to hit. But I have found that has been much more consistent, more so than a percentage. But, maybe your work income is more, it's not as stable. So you got to be more percentage based. But in my case, I found, just picking one number and sticking with it has meant I've seen a much better consistency with contributing. That, and again, with reinvesting, have been the big drivers in seeing this number improve from where it was in September 2023 to August of here in 2024. Distribution's about to come out in the next couple of days, so I suspect it'll be maybe just a little bit higher than that. Be on par, but I don't think it'll be much more than this. There really hasn't been any extra distribution growth, natural distribution growth, which is, again, that's another factor as well. If we count all the different ways that your portfolio can grow, your distributions can grow, like natural distribution growth is a huge one, on top of contributing, on top of reinvesting, and then on top of your portfolio performance as well. So a nice 4 little ways that we can think about wealth building. What are the tangible use cases for me at 34 investing in CoveredCall ETFs? So let's look at that. So for many of you, this is nothing new, but for the newer people, I'm going to explain this. Tangible use cases. I am married, live in a condo with 3 boys, 8, almost 6, and 2. It is a rambunctious household. We need more space. The problem is, to get more space, we are going to have to pay a lot more. Ideally, we would want a house. Who wouldn't? But the cheapest house in our target neighborhood is $1 million at the moment, $1,350,000. If I sell my home, take the equity, that I'll make off of it. You know, not the full amount, but like the equity that I would use for this. I'd probably put 150 down. This would be my mortgage. This is absolutely nuts, in my opinion. There's no way I'm paying that. There's no way I would, in this day and age, I would even consider that. You know, why am I going to bust my butt to try and afford a mortgage like that? I would never see my family. I'd be scrambling to try to work as much overtime as humanly possible. I do not want my quality of life to diminish. So, what am I planning to do? If I don't want my quality of life to diminish, I need more space, but I'm not willing to buy anything. Well, the answer really is I'm going to get into a house rental, and that's coming up. Man, is that coming up lightning fast. Basically around April, May of next year, so 8-9 months away. We're going to sell our home. I'm going to take $150,000. I'll certainly make more off of our place, but it'll be $150,000. Port that equity, put it into a batch of high yielding CoveredCall ETFs in and around the 10 to 12% range. I've done videos on this in the past. Even more recently, I'm kind of playing around with introducing some all-in-ones, some higher yielding sector specific funds to get me maybe more into the 14% range. I've talked about maybe only investing in UMAX, Bank, and ENCL. That would push me into the 16% territory. But anyway, I'm looking at a couple of different benchmarks, right? The 17% range, the 14-ish% range, and then the 11 to 12% range. So I might end up doing a combination of all of that, but we will see. But the main idea I was thinking of it was the higher yielding funds that very tax efficient, and yes, higher yielding. The portfolio was meant to be a little bit more higher yielding to support the offset cost of a rental house. But if I was to go with, say, the 14%-ish yielding portfolio in a non-registered account, still tax efficient, focusing on funds that pay out mostly return of capital, and then maybe a combination of some capital gains and eligible dividends as well. If I got into, pretty much any one of these houses, I mean, some of them are really beautiful townhouses. Ideally, we're going to try to aim for a house. This thing has come down in price considerably. This thing was at like $4,500. So, I mean, I'm watching this market in my target neighborhood. I probably will have a budget of about $4,250 a month. So there is variety. I know there's a lot of talk here in Canada about, there's a rental crisis. There is a rental crisis at like $1,500 a month, basement suites. There is no rental crisis at this amount. A lot of these properties have just sat and sat and sat, and they don't move. And there's that, if you can afford it, there is plenty there. For me, the offset cost wouldn't cover this entirely. It would probably do about half of it, but the other half would just come out of pocket, and it would actually be in some cases, depending on which portfolio I go with, it'd be cheaper than both my strata and my current mortgage as it currently stands. So depending on what kind of portfolio I go with, I'm actually saving some money. If I go with maybe on all encompassing all ETFs that invest in other ETFs, an all-in-one base strategy, then my costs really don't change at all. But I do get to upgrade into a much bigger space. And some of the properties that come up on here, I mean, once again, I understand $4,000 a month might sound nuts, or renting a place might sound nuts. You should trading a physical asset for hypothetical high yields. I mean, once again, you do your right research. You're not just reaching for every high yielding thing that comes your way. Done right, these funds can, they've shown individually they can last the test of time. Covered calls have been around for a long time. ETFs have been around a long time. Merging them together haven't been around for a long time, but you get the idea. So this is what we are planning on doing in the near future here. My TFSA, I plan to keep reinvesting in that. But again, if I decided to use that money and put it towards this, I would virtually be almost rent-free, but I still want my portfolio to grow. So the TFSA is really just there as a support if need be. I'll continue to reinvest in that, continue to contribute to that, max it out every single year. But I'm not gonna use that portfolio to use it to offset any other further costs with a rental house. And like I said, some of these they're beautiful properties. And really getting out of the whole, home ownership mindset was definitely a tough one to do. I come from a family of people who love to buy homes, flip homes, and make, an extra living. I did that for 8 years, buying homes, flipping homes, and renovating them. So no stranger to, like what should I say? Like property investments, definitely no stranger to that. But so this is more of a newer sort of, I really want a house for my family. When my wife and I got married almost 10 years ago, it was probably something like this. We probably thought that we'd live in like a 1980s style build, maybe something like this, but obviously the market has just exploded in those 10 years and has really put that out of reach for us. And I know that there are many families out there that are experiencing the same thing. So, if I can show the proof of concept of this and give it time, then, I think it will add a legitimacy. I understand that is the goal. That is, it's just an idea right now, and it might sound like a good idea for some, maybe a bad idea to others, but I think the proof of concept will be a big deciding factor in giving people confidence of using CoveredCall ETFs in this particular way. So that is the tangible use case for these portfolios. So hopefully you all enjoyed this portfolio overview of just everything from top to bottom, from left to right. As always, hit all the buttons of the like and subscribe variety, and I'll see you all in the next video.